What if you could turn your regular income into a wealth generating machine? Sound too good to be true? Well, I'm here to tell you that it's possible. How, may you ask? The answer is real estate, specifically passive real estate syndications. And today, I'm going to walk you through a real life journey of how to make this possible. We're going to go into detail about how your regular income from your 9 to 5 job or your primary business can serve as a catalyst to grow an investment powerhouse that brings in passive income and allows you to get to the point where work is optional. Now, if this piques your interest, then let's get going. And if you're new here, first, I'm Dr. Jeff Anzalone, a periodontist wanting to get you out of the rat race with passive income. Do me a favor, download the free passive income guide with the link below the video. Now, today we're going to explore the world of investing passively in real estate and the promising aspect of passive income and capital growth that it offers. If you've been told that the only road to retirement is through a 401k or the stock market, then what we're going to discuss today will be very eye-opening to say the least. But first, a little bit about myself. I used to invest in Vanguard index funds back when I started my practice. All right, I would do that. We had a practice, like a practice retirement account. Anything left over would go into these index funds. I got very complacent until I had a wake-up call. And that wake-up call was we were snow skiing with my family years ago, fell, injured my wrist. The wake-up call was, what would I do if I could not use my hands to provide for my family? And this started leading me to question everything that I've learned in the past about a retirement strategy, because I was told that I had to put my money into the stock market and hold it for 30 to 40 years, and then I'd be able to retire. But what if I couldn't continue to do the work that I was doing now? Luckily, this allowed me to start looking around at what other people are doing, specifically wealthy people are doing, and it was real estate. I didn't have time to deal with tenants, management, that sort of thing. Luckily, I found passive types of investments called real estate syndications. And they're perfect for a busy, high-income earner that wants to diversify their portfolio, yet they want to stay focused on what they know best, their career, their job, their trade. Because, we've trained a long time for that, right? But here's the thing. I was blown away when I started doing my research because nobody was educating us back then. It was all 401k or bust. So I decided to start a blog, debtfreedoctor.com, and this YouTube channel to start educating people that there are other things out there besides the typical road to retirement. So what I want to do is to get you to look at your portfolio as like this investment machine. All right, so we're gonna build your portfolio. It's gonna be like an investment machine. And this investment machine, just like any machine, it needs what to run? Fuel, right? It needs gas. It needs fuel to run. And this fuel for the machine is going to be whatever you do for a living, your job, your career. If you own a business, if you own a practice, anything like that, you've spent a lot of time, energy, probably money. You've gone into debt to get to where you are today. If you're like a physician, dentist, engineer, something like that. So you want to focus on what you know best, because that's going to be the biggest ROI that you're going to have than anything else, right? And as you get better, you get more money. As you get more money, this is able to provide more fuel to this machine that you're building, okay? Which keeps this engine running smoothly. Now, this portfolio or this machine, it's in place to basically get you to the point where work is optional. That is my goal for you. All right, that's number one. I was never told I needed to focus on getting to the point where work was optional, because I always thought that work was not optional. I always thought that I had to work. I didn't know any different way. So I'm trying to teach you that there is a different way. If you don't want to do it, that's fine. But it would be nice to get to the point where work is optional, that you can do other things, you could cut back, you could pursue something else if you want to. At least it gives you options, all right? Again, that's my goal for you. And to achieve that, your machine is going to have to continuously grow. It's going to have to expand. And as your investment portfolio expands, your income expands, your choices expand, and your wealth expands, and it goes up, right? Now, let's talk about replacing your income. What does that look like? Well, in the financial world, we often equate this to retirement. But let's redefine what retirement is. It's not about relying on the government to take care of us when we reach whatever retirement age is going to be at that point. 70, 75, 80, who knows? Unfortunately, we've been almost brainwashed since day one to think that we should always just have to go to school, got to make good grades, and you've got to get some type of professional degree, which when I was going to school, that really was the only way, well, at least I was told, that was the only way that I could make a lot of money, get like very, very specialized degree, then invest in a 401k, hoping that it goes up over the next 40 years to someday retire by the age of 70 or 75. Sounds like a blast, doesn't it? Now, my idea of retirement now is about creating a flow of passive income that's going to cover all the expenses. All right, that's it. That's the goal. That is what I want you to think about. Getting passive income streams to come in that basically covers your day-to-day expenses. Not the 12, 15, $20 million your financial advisor said you need based on all the different charts and assumptions and probabilities and all these crazy things that they try to make it so difficult. Maybe they're not trying to make it so difficult. Maybe it just is difficult and they're trying to explain it to us. I don't know. But what I'm telling you is very simple. Passive income, replace expenses. It's really not that complicated. Yet, we've been led to believe that it is. It's all about simple math and numbers. Now, I want you to imagine a life where you no longer have to worry about trading your time for money in order to cover the mortgage, the food bill, trips, anything like that. That, my friend, is true freedom. And that's what retirement should look like. However, transforming this theory into practice can sometimes seem confusing. So let's consider a very concrete example of one of my favorite real estate investments. That is a real estate syndication. A real estate syndication is nothing more than a partnership between two different types of investors. You've got the limited partners or the passive investors, you and me, and you've got the sponsors. The sponsors, they're the ones that go out, they find the property, they manage the property, they pay us quarterly or monthly distributions, aka passive income. All right. Now, what I've done is I've created a chart. Again, this is just for, I'm not a financial advisor, I'm not an attorney, I'm not an accountant. Don't take this as financial advice, but I want to give you sort of an overall view of what a quote retirement type strategy could look like from real estate, covering your expenses with passive income. All right. So most of the real estate syndications that I'm currently in are around 4 to 7 years. We'll say an average of 5-year hold period. All right. So for those of you who don't know, we partner with other people, other limited partners. We pool our money together with the sponsor into an investment that we could otherwise not afford on our own. Instead of me going out and buying a single family home and Airbnb in it, I would go out and I would partner with other limited partners like you, other people. Most of these minimum investments are about $50,000. Some are higher, some are 75 or 100. Most are $50,000. So you go in, you partner with all these limited partners with the sponsor, and now we go out and we buy something big like a mobile home park, RV park, a bunch of Airbnbs, an apartment, self-storage, something like that. So now we're all in together. We're in a partnership together. This LLC is formed that holds the partnership, okay? So now that this is typically most of these are 5-year periods. So what I've done is I've created a chart that, let's say somebody out there wants to contribute $100,000 a year over the next 5 years. What would that potentially look like? Okay. So typically whenever the property is held, you're paid a return. Just like if you put your money in a money market, if you put your money in a savings account, a CD, you're paid a return. Could be 2%, 5%, whatever. Most of the syndications out there, they're paying anywhere that I'm in 7 to 10%. For our example, we're going to use 8%. $100,000 invested, and we're going to say it's 8% annual preferred return. Preferred return meaning we get paid, the limited partners get paid first before the sponsors get paid. Okay, we're the people that are quote preferred, which is what I like, because if the property doesn't do well and doesn't give the limited partners their return, then the sponsors don't get paid. So it incentivizes the sponsors to do their best, because if they want to get paid, they have to do well, because their partners, their limited partners, their passive investors have to get paid first before they can get paid. All right, 100,000 a year, year 1 through 5. And then here's your cumulative investment, which is pretty self-explanatory. I invest 100,000 the first year, next year I invest 100,000. Now I've got 200,000 in, so on and so forth. Next is your preferred return, aka your passive income. Okay, this is what you're going to be paid every year. I'm not going to get into all the specifics of the tax benefits, but you get a lot of depreciation, which is basically the government allows you to write off as the property loses value. The wear and tear on the property, the IRS allows you to write that off as a deduction. That deduction, those get passive losses. The passive losses offset your passive income, which means if they offset it, you are able to defer taxes. Again, talk with your accountant. Depreciation, when you do these, has nothing to do with your W-2 income, your active income. It's only going to offset your passive income. If you keep doing this strategy, you basically keep deferring taxes until you die and you don't pay any taxes. Again, check with your accountant on this, but if you want to see what the really, really wealthy people do, they never sell their property. They just keep exchanging it. Thus, they don't pay taxes. So 8% a year. So 8% of $100,000 is $8,000, okay? The next year, you've got $200,000 in, 8% of that, 16,000, so on and so forth. So basically, this is the amount of passive income that you're getting in. Remember to replace your expenses. That's my goal for you, to replace your expenses. All right, so remember we said the typical hold period, we're going to use 5 years. So this is the sale of the property. They didn't sell it through years 1 through 4, but they sold the property, the first property, at year 5. So at year 5, they sold it. And the majority of these properties that I invest in, I look to where it's projected where we double our investment. Meaning, if we invest $100,000, after 5 years, we double that, we get $200,000. So in this chart, after they sell, that means we have a $100,000 profit because we've got $500,000 invested. We've got the $40,000 that we've been getting, $100,000 profit, total annual income, guess what? $140,000, okay? So note that from year 5 onward, you, the investor, you start to sell these properties. So after the first year, the end of the 5th year, property sold. Next, the 6th year, the end, so 5 years from here, the end of the 6th year, it's sold. You get your profit, and so on and so forth. So it becomes like a ladder. I didn't want to continue. I just wanted to do it here, again, for educational purposes. Now, finally, the total annual income, once this thing starts going, and once these things start going what's called full cycle or selling, that's when things start to snowball, okay? So over here, you're just getting your passive income, and then boom, once these start selling, here's the cool thing. Not all of these are going to be perfectly selling at 5 years. Some of them may go 7 years. Some of them may go 8 years. I've had some that go 3 years. I've actually had some go 2 years. So I've had it to where I've doubled my investment over a 24-month period. So, but it'll all typically will even out. You're going to have really, really good winners. You're going to have most of these average, and then you may have some that take a little bit longer to go. But for the most part, for educational purpose, I want to do this. So please remember, again, this is a very, very simplified example, and investing really involves, several factors, okay? But sometimes whenever I explain to my group, I've got a passive investing group for accredited investors. Sometimes when I have new investors come in, if you're accredited and you want to join, I'll put the link below this video. They'll start asking me all these questions like, well, what's the internal rate of return? Or what's the IRR? What's the equity multiple? What if this happens? What if that happens? What if the place gets shot up or burned down? Blah, blah, blah. Again, there's a lot of things that go into this. I'm trying to give you the sort of the satellite, the drone view, the big picture when I'm talking about this, okay? Did I talk about 40 years in a 401k? No, I did not. Look at what happens at year 6. I mean, you're already getting, in this situation, your $100,000 in passive income. How much do you need to replace your expenses? Think about that. Figure out how much you need to replace your expenses, and then come up with a plan like this. But really, the underlying concept is pretty straightforward. With the right mindset, the right advice, the right strategy, anybody can make the move. The key is to not get overwhelmed and quit. That's what most people do. Why do you think that there's 1%ers? Because the 99% quit. Think about the pros. Think about professional athlete. There's just a few professional athletes and just millions and millions of other people that play sports. Only a few get to the pros. Why? Because they didn't quit. Okay. They didn't get overwhelmed. They stayed focused on the goal. This is a way that you can begin replacing your expenses. I've done it. I'm helping. I've got over 2,000 people in my group. I'm helping them right now. I'm doing this. You can do this. It's not about getting rich quickly, but it's about building wealth to sustain you for the rest of your life. Remember that the power of these real estate syndications, it enables regular investors like you and me to participate in these really high value, high dollar properties that we couldn't buy on our own. And by doing this, you can start to generate substantial passive income and achieve your goal of financial independence. Now, remember, investing in real estate syndications is not a golden ticket to instant wealth. It requires careful consideration, planning, and most importantly, what a lot of us lack, myself included, patience. But again, with the right mindset and guidance from those that are already investing like this, you can use this strategy to build a portfolio that could potentially replace your income, certainly your expenses, and allow you to retire early if you want to. At least it gives you the option to. Now, I really hope this information has sparked an interest in real estate syndications. And if you want to continue your journey on how to invest in them like I do, check out this video.